Hello.
Hello.
Yes, hello. The world of enterprise software and enterprise startups is a pretty rarefied one. Everybody wants to be involved, and yet selling to the enterprise is really quite challenging. Today, on episode number 107 of CXOTalk, I am thrilled to welcome Jason Lemkin, who is a company founder, runs one of the most popular entrepreneur blog sites, start for SaaS founders, and has done a lot of other things. And I'm here with my glorious co-host, Vala Offshore, except Vala's actually not here. Vala, wherever you are out there in the ether, I hope you're doing well. And Jason, how are you?
I'm on top of the world. Thank you very much.
And I assume that everywhere you go, you get royal horns.
I'd hope so.
I think you should expect nothing less. So, Jason, you have a pretty broad background. Tell us about your professional background.
Yep. So I have been founding, running on the management team, and now for the last 17 months investing in startups my entire career. But I've done all different pieces of it, right? From being an advisor to a consigliere to on the management team of startups to founding two of my own companies that sold to the enterprise. The last one was EchoSign, which was acquired by Adobe on July 15th, 2011. And now I just invest and work in SaaS companies. I'm done trying to learn anything new. I just want to harvest and help other SaaS entrepreneurs do even better than me. And kind of in a nutshell, what after EchoSign was acquired in 2011, I came to the conclusion that I no longer had anything left to hide. I didn't have to pretend I knew anything. I didn't have to cover over my mistakes and all the things I'd screwed up, like hiring the wrong first VP of sales or screwing up the sales comp plan or not even knowing what a VP of marketing was supposed to do or what demand gen was. And I decided I would just share everything, right? I had nothing left to hide. And fast forward a few years, we've got 1,300 answers on Quora, 250 blog posts, and we got about 1 million views a month. And we sort of accidentally created this pretty fun community called SaaStr, which I think a lot of, especially first-time founders, to learn and repeat folks more for cathartic reasons are pretty plugged into today.
So you started SaaStr, which, well, first off, what exactly does SaaStr mean?
So I don't know, but I reserved the URL way back in 2010 when everyone thought the enterprise was really boring. You may remember in 2011 when SuccessFactors was bought, the title in TechCrunch was Z. Like it was the most boring thing in the world that there was a $3 billion acquisition. So back then, SaaS was not sexy and hot. It was not 60% of the latest Y Combinator class. So I'm full of bad jokes. So, you know, the last thing I thought a hipster would do in 2010 was be into SaaS. So SaaS was what a SaaS hipster would be. I reserved it for fun. I thought I might use it as something to do at EchoSign. I never used it. But then after the acquisition, I decided I would just share all my learnings and do it under this URL. So it means nothing other than people having fun, learning and growing SaaS things together.
So you're having fun, but you're getting 1 million views a month. And you're the top person answerer on Quora as well.
I don't know if I'm the top, but we're definitely in the top few every month, especially given how niche the content is. I think it's pretty cool. Yeah.
So what are the kinds of issues that you're discussing on SaaStr?
Yeah, so let's step back for a minute. My most profound insight, having done a couple of these startups and sold millions and millions of dollars to big companies and enterprise and small companies as well, what I sort of knew but I didn't understand more empirically is that once you hit initial traction, that first $1.5 million in revenue, once you do, basically all these companies scale the same way for a given ACV, right? So companies with a 5K ACV pretty much all do the same things once they get to $1 million in revenue. Companies with 20K ACV, and ACV, I mean annual contract value, how much your average customer pays you per year. So there's sort of buckets. There's freemium, low end, like Dropbox, maybe the customer's worth $600 a year. There's high velocity inside sales at $5,000 a year. There's sort of lower velocity inside sales at $20K. You get into field sales at $100K and above. And wherever you are, whatever your average ACV is, you pretty much sell, market, and scale the same way as the next guy. Your product may be different. And we all tend to get to that first million in revenue very different ways based on the backgrounds of the founders, which we can talk about, right? If you know how to sell, you'll get there by selling, right? If you know how to sell yourself, maybe you get there through PR and inbound leads. There's different ways to get to that first million. But because we all scale the same way after that, if we just share the operational learnings of how we do that, it becomes wildly applicable to SaaS startups that do 10,000 different things in 5,000 different verticals.
So we have a question from Twitter.
Yep.
I hope I pronounced his name correctly. Bartolome Rodriguez.
Yes.
And he asks, do you usually like to see the growth of your business or investment through any specific tool?
Through tools. Boy, I don't know. I mean, let me step back for a minute. What I do think is important is these days, whether you're using Baremetrics, which a lot of startups use, or other similar tools, I think transparency is the normal in 2015, right? And so I think best practices, what every startup should be doing, is sharing with their investors and advisors or others the metrics each month, every month, regularly. And interestingly, the longer the lag time it is, I find has a strong inverse correlation to the quality of the startups, right? The best startups that I've invested in or work in as an advisor, the best ones get their monthly metrics out in whatever email, whether it's Baremetrics or Excel or whatever it is, they get it out within a week at the end of the month. And the longer it takes, usually the lower relative quality of the startup.
We have another question. So
yeah.
As people ask questions, let's just do that. How's that for you?
Sure. Yeah. We'll dig in on a few of the good questions you and I have chatted about before, but let's hit some few questions from the audience for sure.
All right. So Vasu, and again, I apologize. I hope I'm pronouncing your name correctly. Prathipati, and yep. I know I mangled your name, and I'm sorry about that. Are SaaS sales based on a hard ROI standard? Are SaaS sales based on a hard ROI standard and expected?
Yes.
Do these expectations vary by deal size?
It's interesting. I was having a conversation yesterday. Yesterday I was at a company called BetterWorks. I'm on the board. I've had a goals summit, and they invited about 300 C-level executives to talk about enterprise goals. And I met with a C-level, maybe it was a CIO at a pretty large financial services company. And you know what he said? He said the first year we don't even bother to calculate ROI. And I don't think he meant that. And what I'm talking about is high-end enterprise. We're talking about financial services, right? Fortune 50 company, right? And obviously he didn't mean that they buy products that they don't care about ROI, right? But what he meant then when we're talking about true enterprise, and we confuse this term enterprise with business, right? But when you're selling to the Fortune 500, the Fortune 100, what you really are buying is business process change, right? I'm bringing in a tool to change the way I do business. I'm bringing in Salesforce to change the way my sales team works. I'm bringing in Workday to change the way that we can track and manage our people and interact with this. And so the idea that an ROI calculator is mission critical to that, I think is a bit apocryphal, right? And a little simplistic. But I do think ROI calculators and that whole trend are very important air cover, especially when the person you're selling to and your deal champion has to sell it up in the organization, right? Because if you're selling straight to the CIO, they're going to figure out their own impact on the enterprise, right? But when you're selling to the director of IT, who then has to go to the CIO and convince her to buy this product, right? Which may not be budgeted, then the ROI calculator, as silly as it is sometimes, becomes mission critical. Right, so you got to do it, but understand that it may really be air cover in many cases.
So you mentioned you defined enterprise software as essentially being business process change. Maybe elaborate on that, because I think many founders who especially come out of the consumer world don't have a full appreciation for what that actually means. And it is fundamental to selling successfully into the enterprise.
Yeah, they do. I think so let's step back for a minute. I think when the mainstream tech media went from, in that 2011 example we talked about, boring, thinking that, quote, enterprise software was so boring, it was all Z's in the headline of TechCrunch, to interesting today, right? The challenge, especially for founders, is the term enterprise kind of got redefined, right? And so in the old days, enterprise meant selling to big companies pieces of software, and then let's talk about this, that were, changed the way your business did, took a lot of implementation, a lot of overhead, a lot of change, right? And enterprise software was never something like freemium or low end, like a Dropbox or an Evernote. That would never be considered enterprise software 5-7 years ago, right? Today, these terms have gotten all mixed up, and anything where a business pays money is now called enterprise in the lay press. And I think it creates a lot of confusion. I don't know how to solve it. That train's already left the station, right? So what I've kind of tried to help people understand is break B2B products or software as a service products up into tools and solutions, okay? And tools are generally inexpensive, easy to adopt, right? Slack is amazing, but Slack is a tool, okay, for the most part. But we'll talk about it if you want, why for many folks it can become a solution. But Dropbox is a tool, Slack can be a tool, Evernote can be a tool, it's easy to adopt, often comes out of your own credit card, and does not fundamentally change the way a business works, right? And CIOs don't buy those things, and those are not how 6-figure and 7-figure deals get done, right? Solutions are something that changes one of the core business processes of a company. So, and let's step back a minute. Whether it's a tiny company or a large company, if you are one of the core systems that company runs on, you can charge a lot of money, right? You're replacing people, right? The average person, when my brief tenure as a corporate VP at Adobe, the average fully burdened cost of a person was $250,000 a year, right? You save me the cost of a couple people and make my organization run 10 times better, I can write you a $500,000 check a year. It's no big deal, right? But even as a corporate VP, me getting Dropbox at $5 a month expensed was torture, right? So tool versus solution, and people get confused on the difference. And then at a founder, another interesting question is, can you go from one to the other, right? And Box is a great case study, right? Because we all know Box is very visceral. Box started off as a low-end freemium tool and migrated to become a solution for enterprises to manage their content, right? It became an enterprise content management solution when in the beginning it was a cheap and free tool way to stick files on the web. And so I just think understanding the difference is important. It's understanding for pricing, it's understanding for who you're selling to, it's understanding for value. And ultimately, even if you're killing it and doing well, you need to understand once you get to 1 million, at least in theory, how you're going to get to 100 million, right? And you're probably going to become more of a solution like Box rather than stay a tool like Dropbox.
So this notion of solution then seems to imply that you are doing something that is core to some process or some organizational function.
Yes.
That's not just an individual, as you said, using their tool, but that's actually changing how the corporation works.
Yes. Yes. And so that has good and bad, right? The good is if you're changing the way a corporation works, they can pay more money, right? And I don't just mean literally in the Fortune 100. I've met many startups selling to small businesses, but even relatively small businesses can pay $20,000 or $30,000 a year for one app, right? I call it the app that runs on the monitor on the shop floor, right? The one app that every single person in the business runs their business on, except the tiniest businesses. I'm not talking about independent contractors. But even the smallest businesses can afford to spend $20,000 a year on one app, right? So 5 figures is a very interesting sign in SMB sales that you have a real solution, right? That you're really solving a problem, right? So good news for solution, you can make 5 to 20 times more money, right? Bad news is sales cycles are longer, right? Because you have to think about it more, right? And quote bad news, although this isn't really bad news, is your average enterprise is only going to buy so many solutions, right? And for a given business process, they're only going to buy one, right? So I may kludge together 7 or 8 little sales widgets for my sales team, but I'm only going to buy one CRM, right, for my sales team. So there's going to be fewer apps that are solutions versus tools, but if you hit it, you can get 20 to 50 times the revenue.
The implication of this, however, and correct me if you see it differently, the implication seems to be that, as you said, the planning and the building of this solution is far more complicated, because you don't just, if you're building a solution, you're not just building a feature. So it means you have to have very significant domain expertise.
Yes.
And then the sales process is also very complicated, because you're not just selling to one person in a single department necessarily, but you're now selling to a team, and you have to satisfy all of their constraints.
You do. And that's why if you look at a lot of SaaS apps that are started by first-time founders, they usually don't have that domain expertise, right? They don't know how to sell the power. They don't know how to sell a solution. They don't even know what business process change is. So many, at least by number, most of the SaaS apps we see today start from the bottom, right? They start either with small businesses or individual users or silos or groups or an individual application. And when Aaron Levy started Box, he was 20 and a sophomore dropout out of USC. He'd never sold to the enterprise, right? Now CIOs love him, right? So that migration path is the way the majority of SaaS founders do it, because they can't do it any other way, right? But interestingly, a lot of the repeat founders skip that step, right? If you look at Josh James at Domo, he's not messing around this time, right? He sold Omniture for $1.5 billion last time. He's going for $15 billion this time, and he's skipping straight to the enterprise. But most of us founders don't have the skill set to do that. So you almost have to start as a tool with freemium, with SMB, and then learn, like Aaron Levy and Box, how to go up market over time.
And how common is that? How common is the ability for a founder to be able to make that leap?
Well, all of it's uncommon, right? Which we could chat about, right? Success is celebrated far more often than it occurs. But in my, with the companies that I work with and the CEOs that I know, it's relatively common that you can do that, right? I invested last year in a company called TalkDesk. Just last July, it was doing about $1 million in ARR. By this July, it'll do over 10 million in ARR. So 1 to 10 in 12 months, right? And that's not quite Slack or Zenefits, but it's pretty breathtaking, right? And in that time, TalkDesk has quickly grown into many, many, many 6-figure deals, and 6-figure deals are routine, right? So it happens a lot. I can give you many other examples. We had a company called GuideSpark that presented at the SaaStr annual. They went from 2 to 20 million in 2 years in ARR, right? And they did it by driving their ARR, their average deal size, from about 20K to 300K, right? So it's pretty common, but success is always uncommon, no matter what it looks like in the media, right? But my learning from all of this is, if you haven't done it before and you're a first-time SaaS founder, the most important thing I say to you then is listen to, when you get 1 or 2 big customers, don't dismiss them, okay? So if I had to go back in our top 20 or 100 mistakes in my first year as a SaaS founder, you know what one of them was? When we closed our first couple enterprise customers, some of the folks on the founding team thought they were anomalies. They didn't want to support them. Those aren't anomalies. Those are the future, right? If in your first year as a paid product, you can get a Fortune 100 customer, that is the future, right? So if you haven't sold to the enterprise before, to the true enterprise, to big companies with business process change, and you get a 5 or 6-figure deal your first year, don't view it as a pain in the neck. Don't view it as a distraction. Don't view their feature requests as annoying, right? View it as a gift from heaven, right? As mana, as a chance to learn. And that's the way that you can go up that value chain into a solution, by taking advantage of any you get, right? And if you're out there for 2 years as a SaaS founder, and it's been 24 months and you don't have a single big company customer or enterprise, maybe you'll never get one, right? Maybe that's not your product or your DNA. You never will be a solution.
So the path to, that's supposed to be a cash register. It sure doesn't sound like one. So that sounded like pennies dropping. So the path to revenue and to really meaningful revenue, then based on what you were saying, depends on being adaptable to take what's coming and evolve yourself on the basis of it.
Yes.
And yet at the same time, how does a founder or a team, how can they discern whether or not this this flexibility is just chasing rainbows and in fact is distractedness? How do you make the determination?
Well, let's step back for a minute, right? So let's in this age of 120 folks in the last Y Combinator class and every single person we know becoming a founder, let's step back for a minute. One of the big things that's different in 2015, even from the last wave of 08 or 09, let alone that first wave of like me and Box in 05 and 06, is there are 10 bajillion web apps today, right? And nobody needs another web application, no business, right? Everyone, look at all the businesses in your block, on your street. Are any of them going out of business because they don't have your web app? No. Every business is doing just fine, right? So the last thing anybody needs is to invest a whole bunch of time to find another web app. Maybe if you're in security and you work at Target or Sony, it's different, right? You're desperately looking for security solutions that work better. But for business process, no business is going out of business because they don't have your new web app that no one's heard of. So what does that mean? What it means to me is that if you have what I call 10 unaffiliated customers, if you can close 10 customers that are not your ex-bosses, your friends, from the enterprise or regulars, from the whatever, 10 folks from the ether, even if they only pay you 20 bucks a month, you have something, okay? You have something because no one's ever heard of you. And if you can get 10, you can get 20 and you can get 100. And if you're tenacious, you can get 1,000, right? So I say ignoring money and all the stresses of founding a company and everything, just see if you can get 10 unaffiliated customers and then do whatever you can to just double down and keep going, right? Because it's impossible to get 10 unaffiliated customers, right? And then just don't quit, right? And then commensurate with that is the other mistake a lot of founders make is because it's so hard to get 10 and because it takes so much time and so many iterations, if the founding team is not sufficiently committed, you have almost 100% chance of failing, right? The initial founding team has to commit for 24 months to have any meaningful revenue, right? We just talked about Talkdesk that it's going to go from 1 to 10 or more in 12 months, but it took them 2.5 years to get there, to get to that first one, right? We talked about GuideSpark 2 to 20 in 2 years, but it took poor Keith Katani, the CEO, 4 years to get to that first 2 million, right? Slack, amazing explosion, $3 billion valuation yesterday, right? After only being in business as Slack for a year. But its predecessor company and all this around for 4 to 5 years, right? This overnight success in SaaS often is preceded by 2 to 3 years of desperately trying to get that first million in revenue. So get to 10 unaffiliated customers, don't quit, and make sure your founding team is willing to commit to 24 months to the first million in revenue, then you've got a shot.
Boy, what a tough potential road to hoe, because you're committing, absolutely committing based on what you're saying,
Yes.
24 months
Yes.
into the unknown and the absolute uncertainty of any type of meaningful result.
Yeah, if you can't do that, go build Instagram, right? I mean, I tell you, I was invited to speak at the Stanford Business School a couple months ago, and this is when I had this 24-month insight. I mean, I knew it, but I didn't know how to summarize it into a sentence. And I got it from the students, and I said, well, and most of the folks in the room wanted to do B2C, right? Most of them wanted to do consumer, but a lot of them wanted to do B2B or SaaS or enterprise. And I said, the one thing I can tell you guys, if you don't, let me tell you, it's going to take you 9 months to figure out if your product works, right? And maybe another couple months to get those first 10 unaffiliated customers. And then you won't even be doing anywhere near $1 million in revenue. It's going to may take you another 6 to 9 months. That's 20 months total just to get to that $1 million. And you may need a buffer. So that's 24 months. And if you don't commit for 24 months, you have like no chance of success. And these aren't 20-year-olds out of MIT going into YC. Not that YC, they're not all older now. But they're still relatively young kids in school, and all of them were like, well, what am I supposed to do? I can't afford to live for 24 months while building my company. Not my problem, right? I mean, then you shouldn't be an entrepreneur. Go work at Salesforce or Facebook or Google. These are amazing jobs, right? Go work at Zenefits or GuideSpark or Talkdesk or BetterWorks. Don't start your own. It's not meant to be easy, right? It's supposed to be hard, right? No, So yeah, go solve that problem. Raise extra money, work on ramen, do whatever it takes. It's not my problem. What I can tell you is all the great companies find a way to commit to 24 months to first meaningful revenue in B2B.
We have an interesting question from Alex McClafferty, who asks, what are the signals you use to identify a dead in the water or zombie SaaS startup?
Wow.
That's a good question.
Yeah. So I think that so let's step back for a minute, right? Let's define what a dead in the water or zombie startup is, because all recurring revenue companies should always grow. They should always grow, right? I've talked a lot about this concept of, we talk a lot about second order revenue. We talk about upgrades, upsells, all of this. There's always churn in recurring revenue, but you should always have more growth than your churn, right? So, a true zombie is a SaaS company that's not growing. That's just awful, right? That's a crime. But maybe the bar is higher than that, right? I'm going to say that once you're at even just $1 million in revenue, if you're not growing, if you're at $1 million, if you're not doubling year over year, you're a borderline zombie, right? You're growing too slowly to ever get there, right? Because you've got to get, the key to making the whole SaaS thing work is getting from 1 to 10 as quickly as you can, right? Your average SaaS business needs a whole sales team like you talked about. You need customer success, right? You need product management. You need marketing. You need demand gen. You need basically 50 people to make a SaaS company work, right? And think about what that costs, especially in California, the Bay Area. It costs you $10 million a year, right? So you got to get to that 10 million to make it a viable business. And if you're at $1 million and you're not even growing 100% year over year, I'm not sure in 2015 you'll ever get there fast enough. So given that, how do you know if it's a zombie if you don't have them? If you have the numbers, you'll know from the numbers. If not, I think if you look at their LinkedIn and you see they're not adding headcount commensurate with that growth rate, they're probably a zombie, right? You can learn a lot. And Mattermark, interestingly, sucks this in as a core data point. But if you're not seeing that at least 60% employee growth year over year, they're probably a zombie.
So what's the set of criteria then that you use to evaluate an investment? Yep. And I'm asking really from the point of view of the founder to help expose these lessons to SaaS startup founders.
Yeah, and I can tell you exactly what I'm looking for, and it's kind of sad because I didn't achieve it. So listen, I had a great exit. Returned 5x to my investors. It was good. All was great, especially by 2011 standards. But I'm looking for companies that did better than me, right? And what I'm actually looking for, let me quantify it, and then I can give you some other characteristics. In today's world of Slack and Zenefits and TalkDesk and these other hypergrowth companies and GuideSpark that we talked about, I'm looking for companies that can, and I'm often going to invest before the stage so we can chat about that, right? But I'm looking for customers that at least in theory have a shot of going from 1 to 10 million ARR in 5 quarters or less, okay? And to summarize that, it's not quite here, but that really means once you hit $1 million in revenue, you've got to be growing at least 15% month over month, okay? Even that doesn't quite compound to that number, but it's close enough, okay? So if I meet a company, but most of the companies I'm meeting haven't hit $1 million in revenue yet. I'm an early stage investor, okay? But if I have and they hit $1 million and they're growing 5 or 6% a month, which in classical times would be okay, it just, as a VC now, I can't invest. There's no way I'll make enough money, right? So the bar's gone up. And when EchoSign and Box and these companies got started back in the day, no, we didn't see that type of growth, right? Salesforce did, but no one else did. But that's the bar. That's, Slack is $3 billion, but it ain't $3 billion because it's growing 6% month over month, right? It's $3 billion because the investors are expecting Slack to go from 1 to 100 million in 2 years. Zenefits that spoke at the SaaStr, they're apparently raising around a $3 billion now too. And Zenefits is projecting 1 to 100 million run rate in 2 years, okay? I'm not asking all startups to do that, right? But I think the bar is 1 to 10 million ARR in 5-ish quarters, or at least if you're investing earlier, like I often do, at least you hope they can, right? You try and read the tea leaves. Is the team strong enough? Is the early customer growth good enough? I look for, can deal sizes go up, right? Because even if your customers are only $5,000 a year today, if some of them are 20 or 50K, I know you have a chance to drive deal sizes up, which makes the physics of recurring revenue easier, right? But it all boils down to hoping, and as a VC, most all of them don't work out, but hoping you can do 1 to 10 in 5 quarters or less.
So Jason, what happens then, the example of a company that looks like it can achieve the kind of revenue that you're talking about, and yet maybe not at the growth rate that you're describing?
Yep.
In any other world than the VC investing world, such a company would be considered wildly successful.
It would, yeah.
And so the situation that you're describing is...
That's why I say it's kind of sad. And I didn't even get to 1 to 10 in 5 quarters. So I don't judge anybody, but keep going, right?
So basically then what you're saying is that there's only room in the market for either a small non-VC fundable business, a lifestyle business, which people call, and I don't mean that in any negative sense whatsoever,
yep.
At the low end, or these hyper-growth companies at the high end, and anything in between basically seems impossible based on what you were describing.
I think so. It's confusing. You see all this press on TechCruncher and Dan Primack's newsletter, all these funds getting raised, bigger funds than ever, right? It seems like you see all these monster rounds every day, right? 80 million into this and 50 million into this and 200, whatever it was to Slack, 160 million. And that's happening, but it's also, but no one's dumb. People think people are dumb or investors are dumb. No one's dumb. The bar has gone up. But the thing is, when you hit it, the valuations now are much higher to reflect the higher growth rates, right? So our jaw drops at Slack at 3 billion, but if Slack can do 1 to 100 million in 2 years, I'd say based on current multiples in the current crazy world we live in 2015, I'd say it's justified, right? If Slack goes from 1 to 20 in 2 years, that valuation is insane, right? So yeah, it's tough. If companies had the metrics of a Box or an EchoSign or maybe even a Yammer or an Evernote or pick your brand name, I don't think they get funded today, right? Couldn't get funded, right? And it just sucks. And at some level it sucks, but on the other hand, it makes sense because what's different today is so 2 things are happening that are different. More, and the first one you're very familiar with, Michael, from everything on CXOTalk. So much more of the CIO's budget is being migrated to SaaS, right? So if you hit it and you're selling to the CIO or true enterprise, you should grow faster because there's more budget than there was a few years ago. The overall CIO's budget hasn't changed much other than for inflation. But the percent of a $1 trillion budget going to SaaS, it doesn't take too many basis points for that to create 50 IPOs, right? So that trend is accelerating. And the other trend that's accelerating outside the CIO's office in SaaS is that more and more segments of the market and businesses are getting SaaSified at a much higher rate, right? So because all of that is accelerating, the best companies should grow faster, right? They should grow faster. And if you're not, something's not quite right. Don't quite have the product market fit you think, right? Or something's off because all the markets are bigger than they were just a few years ago.
Okay, you've been talking revenue and growth have
Yep.
been at the center of the points that you have just been making.
Yeah,
and so,
I think growth solves all ills. That's why.
Say again?
Growth solves all ills in recurring revenue businesses, right?
Okay, growth solves all, okay, I'm writing
all
that
ills.
down in the
Because for a real SaaS business and we have, say, 80% plus margins, growth can solve all your problems.
Okay, so let's talk then about how do you achieve growth, and let's talk specifically about selling to the enterprise,
Yep.
because I think, again, it's one of those areas that unless you've been involved with large organizations and
Yes.
this dynamic, it's not intuitive at all how you sell to the enterprise.
So let's step back a minute. As something that, and this doesn't help founders who are desperately trying to hit the number this month, right? But when you're taking a longer term view and trying to build a unicorn or decacorn or $100 million business, understand that at the end of the day, almost every great business, period, and almost every great software company has been built on word of mouth, okay? The most extreme version of word of mouth is virality, right? So you see a WhatsApp, I mean, this is B2C, you see a WhatsApp or a Snapchat or Instagram explode, or a Facebook, because that word of mouth becomes a piece of technology, right? But everyone grows through word of mouth once they have a brand, right? So once you have, and even what I call a mini brand is, it's not Coca-Cola, it's not Salesforce, it's not Workday, right? But once you have a brand just for your core customer, that they will have heard about it. I call that a mini brand. And that can happen as early as 1 or 2 million in ARR. Then those customers start to get you more customers, right? So to give a personal example, let's step back. It took us 18 months to close Google, okay? It was a lot of work, right? From Google, I think it took us 90 days to close Facebook, right? And then after Facebook, I think it took us 30 days to close Twitter, right? So you see that happening, right? We did it in insurance too. It took us like a year to close Aetna, and then I think it took us 90 days to close Cigna from that, right? And then they just kept getting faster and faster and faster. It wasn't just because we got better at knowing how to sell to these verticals, although we did, right? It's a mini brand, right? And so if you abstract everything away, what's the game plan here, right? First, figure out how the heck to sell something to those 10 and 100 unaffiliated customers, which has got to be hustle and chutzpah, because no one's heard of you, right? It's some kind of hustle and chutzpah, whether it's outbound sales or press or PR or AdWords or product hunt, somehow getting out there, right, and connecting with hyper early adopters. And then what people tend to do in different ways is they underinvest in that brand in what I call second order of revenue. And they underinvest in the customers they have, and they overinvest in trying to get new customers, which is natural, right? And as soon as you have even 100 customers, I would argue, especially as a CEO, you should spend at least half your time with your existing customers, not with prospects, okay? And then you can figure out everything else once you have a brand that people love, that people are paying for, right? That's the real secret to this whole thing, is getting to mini brand and then over-investing, not under-investing in mini brand. So that's why I say over-invest in customer success, right? Make them happier. And as a CEO, get out in front, off your Mac and get on a jet and go visit your fracking customers wherever they are. They will get you more customers, right? Have a customer conference like we did at BetterWorks yesterday, right? Even if you're only a year and a half old, have 200 customers come there. Do this stuff because you can figure out the rest of enterprise sales. You can hire talent. You can hire folks that have sold to the enterprise before. We can chat about that, right? But this key is the mini brand and second order revenue. And it just takes, the thing is, the bigger your deal size is and the more enterprise is, it just takes longer. Right? It takes longer. The larger the deal size is, the more money you get, but the longer the sales cycle.
So Jason, what you've just said is when you're beginning, it's hustle and chutzpah. That's how you sell. Yeah. However, once you've built that mini brand, then your sales approach is going to be very different, which implies that the activities that a SaaS startup team must undertake change quite dramatically as the life cycle of the company evolves.
Yes. Yeah. Yes. And hopefully from a sales strategy that you're able to sequence a couple things at the same time. Hopefully, usually, whether you're any good at it or not, every great founder CEO has to figure out how to hustle and chutzpah and get those customers, right? And then hopefully by then you've hired, even if you've never done this before, as most of us haven't, you've hired 2 to 3 sales reps under you that are successful, right? And they may be quirky, and they're probably going to be very different from sales reps 20 and 200 and 300. But 2 to 3 folks that you trust, that you believe in, that can work with you, and that can replicate a little bit of the secret sauce you figured out in hustle and chutzpah, right? And usually those 2 to 3 plus you will be structurally sufficient to get you to that $1 million, $1.5 million in revenue, which also will equal your mini brand, right? And so if you were able to do all that, usually it's the perfect timing to bring in a VP or senior director of sales or whatever to help take that mini engine that's just starting to work, right? That's just starting to come together, and then help you just run that thing faster, right? So that's the playbook, right? And the mistake a lot of us make is we bring in the VP of sales too early, right? Before the wheels are starting to turn, and that never, ever, never, never, ever, ever, ever works, right? You want to bring the VP of sales in when the wheels on this train, this heavy steam engine, are just starting to turn on their own, right? And all the VP of sales is going to do is this. That's all they do, right? VPs of sales are not magicians. They don't create customers out of thin air. A VP of sales cannot sell an unsellable product. If your product is unsellable, the VP of sales will not solve that problem, right? A VP of sales is a manager, a process manager, and a recruiter, right? And so, but the good thing is if you can get 2 to 3 reps under you working, get to $1 million, you will have a mini brand, right? You will start to get referrals. You'll start to get second order revenue. You'll start to get people talking about you, and you're ready to go for it.
Okay, we have another question, an interesting one from Satya Ghani, who asks, what do you value more highly, product market fit or execution capability?
It's interesting. We were just having this discussion last night. It depends whether you're pre or post initial traction, whether you're before or after a first $1 million, or maybe even earlier. Let's call it 20K in MRR, okay, $250,000 a year of annualized revenue. Because no one in the world needs another business product out there, right? If you're before 20K in MRR, $250,000 a year in revenue, all I care about is product market fit. I care about nothing else because no one needs the product. As soon as you have a statistically significant number of customers, which is probably 50, right? Then the execution engine becomes incredibly important, right? So I'd say the dividing line is probably 50 customers. Before 50, I'm not sure you have product market fit, so all I care about is product market fit. After 50 customers, I don't even care I don't even need to see a demo of your product. I don't even need to see it to invest. Then I want to know how you're going to execute and get from 50 customers to 5,000.
Okay, so to put it another way, in the early stages up to say 50 customers, all you're really trying to figure out is, can you build shit people want to buy?
Yes.
And then at some point that changes, and now you're building the machine. Can you build a machine to do this over and over and over again?
Yeah, and I can help you build that machine. I can help you recruit the people and figure out the right people, right? Personally, I can't help you with product market fit. If it ain't there, it ain't there, right? There's 100 new web apps built every month, and maybe one of them is going to have product market fit, right? Or not one, but 1%. I can't solve that problem. I'm not that smart.
So basically, what you're saying, as far as you're concerned, stars are born, not made.
Yeah, or even personally, I've done pre-revenue and post-revenue investments. But if it's pre-revenue, I don't need to see a deck. I don't need to see slides. I don't need to see a demo. It's just the team, right? Before those 50 customers, I'm just betting in an amazing team, pointed in a pretty good direction in a decent space, right? Post initial traction, then, post 50 customers, I'm just trying to hope that 50 can come to 5,000. And hopefully, because I've gone from 50 to 5,000, maybe I have a slightly better insight than someone else, or I will see less risk than someone else and be able to pull the trigger on one of those deals that maybe other people see as too risky.
We only have a couple of minutes left.
Yeah.
You've been doing this for so long, you've had so much experience. Drop on us some advice for founders, just deep from your heart.
Yeah. I think just two things. I think the most important thing is, if you don't have an A+ team, fix it, right? And because the difference between a good and a great company is orders of magnitude from financial and life experience returns, right? So if you've got let's break it up into 2 phases, founding team and later, right? If you've got a set of founders, and they may be individually extremely talented, I bet they are, but if you don't have this great team that is going to go into battle together every single day for the next 24 months and get to initial traction, take a pause. Don't launch. Find a new founder. Find a new something. Don't start something without a great founding team that's committed for 24 months. You're just going to fail, okay? So then you're into it for 24 months. You're at initial traction, right? And then my other bit of advice is just, if you don't have the perfect set of founders, go bring those people in. It's never too late to add an amazing person to the team to carry some of that load. And whatever you do, once you have something, even if it's just those 10 customers, the 50, $1 million in revenue, $2 million, make sure you're not carrying all the load yourself. It's too much, right? And if you don't have a co-founder at that point that can carry the load with you, it's okay. You can find one or two amazing people on your management team that are almost what I call ex post facto founders, right? They care so much about the product and the passion and their A pluses that they can do it, right? And for me, my VP of sales, my VP of product, even my head of customer support, and others, all of them cared so much about what we're doing. It's hard, and CEO is the hardest fracking job on the planet. Man, it's 50 times harder than anything else I've done, right? Whenever VCs complain about how hard their life is, I just want to like roll my eyes and blow my brains out. You don't know what it's like to be a CEO. It's 50 times harder than a VC, and it's 20 times harder than a VP. So find an ex post facto founder or colleague to help you carry the load, because you'll never make it there otherwise. So from the heart, those are the two things I worry about, because very few of us can do it on our own, right? That's why they came up with the term called partners.
All right, Jason, you have really given us a lot to think about this afternoon.
Good. Well, thanks for all the time, Michael. It's good that we got questions from Twitter. We went a little off the script, which is always more fun. So thanks for having me. This was great.
Well, thank you. You have been watching episode number 107 with really the great Jason Lemkin. And Jason, I give you a big hand. Everybody gives you a hand. My co-host, Vala Afshar, has been out somewhere in the ether. And I hope you come back next week for episode number 108 of CXOTalk. And Jason, I hope you'll come back and be our guest another time.
That'd be great. Thank you.
All right. Thanks, everybody, for watching. See you next time.